Please welcome the President of the Deutsche Bundesbank, Jens Weidmann. Please, the floor is yours. Hello, nice to see you.
So the transition from a hackathon to a central banker is quite harsh, I fear. But nevertheless, thank you very much for your warm welcome, dear Gabriel. It's a pleasure to be here with you, ladies and gentlemen. Thank you for inviting me and having me to your annual conference. And I'm very honored to speak before such a distinguished audience. These days, we often look back at the events of 10 years ago, in the autumn of 2008, when the financial crisis dramatically came to a head, and with good reason, after all, we are still grappling with the fallout of the crisis even now. I too would like to take this chance to recall an event from that time and briefly look back on the life of an extraordinary person. On November 1st, 2008, Jacques Picard, one of the most important explorers of the deep sea, passed away. His name is chiefly associated with a great adventure, namely diving to the deepest part of the world's oceans. Together with his father, he had designed a new kind of submersible, the Trieste. And Jacques Picard and his companion Don Walsh used this vehicle in 1960 to become the first people to dive to the bottom of the Mariana Trench, a descent of almost 11,000 meters. Their journey took more than 4 hours, the pressure on the vessel increasing with every meter. And just to get an idea of what this would have felt like at the bottom of the sea, imagine 3 SUVs stacked on top of each other and balanced on your toe. But the Trieste withstood the enormous pressure and returned its passengers safely from the ocean bed to the surface. Jacques Picard's record has never been broken. No person has ever dived deeper since then. So you might wonder by now, why am I telling you all this? What does this legendary diver, did I grab the wrong speech? Or what does this legendary diver have to do with the topics that we are addressing today? Allow me to keep you in suspense a little longer, given that this has been a long day for you, and I will reveal the answer a few minutes from now. In the meantime, I would like to address some challenges for insurers that arise from the persistent low interest rate environment, and when contemplating where real interest rates will be heading, the so-called natural rate of interest may provide some insights. But first, let's return to the autumn of 2008. In the past few weeks, reports on the events of that time have mostly centered on the demise of the investment bank Lehman Brothers. There was a game-changing moment, there's no question about that, but it's easy to forget that the US insurance corporation, AIG, was also on the brink of collapse at the same time. AIG, as you're all aware, was a company with more than 76 million customers in about 140 countries. But AIG was not only much larger than Lehman Brothers, it was so heavily interconnected with the entire financial system that its insolvency would have shattered confidence in already fragile financial markets. The unforeseeable consequences of a possible AIG bankruptcy compelled policymakers to take action. Just one day after the Lehman bankruptcy, the US government jumped in to save AIG. And with that in mind, one key lesson learned from the financial crisis is that in terms of risk to the stability of the financial system, it would be short-sighted to look only at banks. Rather, all financial intermediaries need to be adequately regulated and sufficiently supervised, and this applies also and especially to insurance undertakings. And we've already made great strides here. Under the European supervisory regime, Solvency II capital requirements are now explicitly risk-based. Additional capital buffers act in a similar way to flu vaccinations. They don't just protect the individual, but also prevent others from being affected. Insurers with more capital are more robust in themselves and thus render the financial system as a whole more resilient at the same time. So the current regulatory regime for insurance cooperation is already helping to mitigate systemic risk. However, it was designed with a micro-prudential angle. We should also take the system-wide perspective, though. Insurers could act as systemic amplifiers due to their high degree of interconnectedness with the financial system. If insurers respond to shocks in a similar way, this can lead to contagion effects. For instance, insurers may decide to stop holding certain asset classes, and the sale of assets into a falling market could, of course, amplify the initial fall in asset prices. By doing so, the insurance sector could reinforce or pass on shocks to the rest of the financial system as well as to the real economy. And I find it a welcome development then that both EIOPA and the ESRB have taken up this issue and turned to discussing the system-wide perspective and also the potential need for additional instruments in the insurance sector. Their reflections will be channeled into the review of the Solvency II directive. Macroprudential tools for insurance companies could prevent a collective buildup of exposure or dampen amplifiers to avoid spillovers to other sectors. As the Bundesbank has pointed out in its recent financial stability review, two examples of instruments under discussion in international fora are insurer-specific system capital add-ons and counter-cyclical capital buffers. Three aspects, I believe, are particularly crucial in this context. First, insurers are, of course, not banks. They are exposed to different types of risks, underwriting risk, for example. Moreover, the vulnerability even to the same risk type may differ depending on the business model of financial firms. Therefore, macroprudential instruments cannot simply be copied one-to-one from banking system to insurers. Second, we have to take the macroeconomic repercussions into account. After all, regulation is always an act of balancing, as has already been pointed out. On the one hand, regulatory reforms aim to improve the resilience of the financial system as a whole. On the other hand, regulation could suppress market activities that foster efficiency, innovation, and growth. A system that tries to prevent crises at all costs would very likely not fulfill its macroeconomic function. And third, when developing new instruments, we should always consider the interplay with existing regulations and interdependencies with other parts of the financial system. Claudio Borio recently warned of possible evasive action, saying that macroprudential instruments, and I quote, can leak if, i.e., they are subject to regulatory arbitrage, possibly pushing activity into the darker corners of the financial system. Such leakages are typically the result of too narrow interventions in the sense that they were designed to target very specific market segments or activities. As a result, the scope of the macroprudential tool could easily be circumvented. For example, in Malaysia, tighter loan-to-value limits on mortgages were only imposed on mortgages to individuals. And that led to a surge in home purchases by firms which were specifically established to bypass this particular regulation. To avoid arbitrage or migration of risk between sectors, the scope of measures employed needs to be broadened. The aim is always to look at the bigger picture of the financial system. In sum, regulation needs to strike a balance between adequately addressing sector-specific risks and ensuring consistent rules across sectors. Ladies and gentlemen, regulation with higher requirements on the risk management is necessary, but of course at the same time also increases the administrative burden and short-term costs for insurers. In contrast to that, its benefit in the form of financial stability only unfold in the long term and also, of course, benefits the whole society, not the specific company. However, new regulation is not the only challenge currently facing insurers in Europe. There's also the matter of advancing digitalization, for instance. New competitors, such as fintechs, are entering the markets. Established insurers need to adjust to stay successful. They must be prepared for new customer expectations on communication, reachability, and, for instance, responsiveness. Nonetheless, insurance companies can also benefit from digitalization by taking advantage of opportunities to raise flexibility and productivity and simplify processes. Big data analysis, for example, can improve the assessment of risk and fraud detection. Another challenge facing insurers is, of course, the low interest rate environment, which is putting many established business models to the test. A low for long interest rate scenario would lead to depressed net cash flows and solvency ratios, and thus to greater risk of insolvency, as a recent BIS paper confirms. The paper also shows that such a scenario would ultimately be harder on insurance and pension funds than on banks. But an abrupt interest rate hike also harbors risk, as Mark Feodoria and Till Förstermann highlighted in a recent Bundesbank discussion paper. Let's take the example of life insurers in Germany. Surrender options allow policyholders to liquidate their investments early and receive the policy's surrender value, and the amount does not depend on current market interest rates, but rests on paid-in premiums at a guaranteed rate of return. If interest rates rise, the value of insurers' asset holdings will fall, and beyond a critical company-specific interest rate level, the guaranteed surrender values exceed the market value of the asset holding, and this increases the incentive for policyholders to surrender their policies and reinvest, of course, the proceeds at higher yields. But an upsurge in policy lapses would mean considerable liquidity outflows for insurers, and to meet the policyholders' claims, they could be forced to offload their assets, which might accelerate the fall in bond prices, driving up interest rates even further. And this can be more than a merely hypothetical scenario. Surrender-driven runs on insurance companies have indeed occurred in the past. In 1997, in the wake of the Asian currency crisis, market interest rates in Korea shot up from just over 12% to around 30% within 1 year, and this saw monthly surrender rates for pension products climb as high as 4%. In 2008, one of Belgium's largest insurance companies faced a severe surrender-driven liquidity crisis. The impact of the financial crisis had pushed the market value of the insurer's asset holdings so low that the company needed to raise 1.5 billion euro in new capital, and in the end, the government stepped in to halt the flow of redemptions. Both incidents, though, had a minor impact on the wider financial system. However, I would argue that we cannot take such an outcome for granted for the future. Liquidity risk in the life insurance sector and its interconnection with interest rate risk should therefore remain on the radar screen of insurance companies and their regulators. So, what we've learned so far is that both persistently low interest rates and an abrupt rise in interest rates can pose serious problems for insurance undertakings. And it's this observation that brings us back to Jacques Picard's intrepid diving expedition, which I mentioned in my opening remarks. In today's low interest rate environment, you could argue that insurers are a lot like divers. For a while, they are quite fine in the deep, but if the dive lasts longer than expected, they risk running out of oxygen at some point. On the other hand, coming back up too quickly can result in decompression sickness. Divers who surface from very deep water too quickly can suffer serious symptoms. At worst, these symptoms can be life-threatening. So divers are therefore advised to make a slow but timely ascent to the surface. It's probably safe to say that many insurers are hoping that a similar scenario will unfold with respect to interest rates, in other words, a gradual rise. Ladies and gentlemen, the evolution of interest rates concerns us all, insurance companies and monetary policy makers alike. Whenever the future level of interest rates is discussed, attention quickly turns to central banks. Amongst other reasons, this is, of course, because of the special role they have been playing in responding to the financial crisis. Central banks all over the world took extraordinary measures, pushing policy rates to zero, providing excess liquidity and purchasing assets on a large scale. In doing so, they contributed to a low interest rate environment that persists in the euro area to this day. 10 years on from the peak of the financial crisis, we have emerged from serious crisis threat, but the Eurosystem's monetary policy stance remains exceptionally expansionary. The anticipated end of net asset purchases marks only the beginning of the exit from ultra-loose monetary policy. It is the first step on a path of normalization which will last several years. So what does this mean for insurers and pension funds which depend on capital market rates? Needless to say, interest rates will pick up as monetary policy gradually returns to normal. However, monetary policy does not dictate the level of capital market rates at the end of this process. Real long-term interest rates are crucially determined by saving and investment decisions made by households and enterprises. Indeed, beyond the recent period of low interest rates, we have witnessed a considerable decline in real yields on long-term government bonds in major advanced economies since the start of the 80s. Owing to its persistence and outreach, this decline is often attributed to secular or global forces. And in particular, a recent study points to lower trend growth as one of the major factors, which is possibly linked also to demographic changes. And given the decline in the actual real rate of interest, numerous studies suggest that the so-called natural rate has also decreased in recent decades. That is, the real interest rate at which goods markets are in equilibrium and prices are stable. And this rate might have important implications for monetary policy. In particular, the natural rate is often seen as a benchmark for the monetary policy stance. If the key interest rate less the expected inflation rate is below this interest rate, monetary policy is expansionary as it provides incentives for consumers to purchase more and for enterprises to step up investment and output. Therefore, the natural rate may be an important anchor for monetary policy to achieve its objective of price stability, at least from a more theoretical perspective. Simply put, if monetary policy tracks the natural rate in the medium term, it will likewise stabilize inflation in the medium term. Importantly, this implies that a depressed natural rate of interest would pose serious challenges for monetary policies to stabilize the economy and achieve price stability. Monetary policy would see its policy rates come up against the lower bound more and more frequently, and this might raise calls for a change in the monetary policy strategy, or at least a change in monetary policy instruments. However, before jumping to conclusions, we have to take studies pointing to a trend decline in the natural rate with all due caution. This rate cannot be observed directly, as you all know, and we have to rely on models and econometric methods to estimate it. And this estimated level varies greatly depending on the method and data used. On top of that, it can often only be gauged with very wide uncertainty bands. Over 80 years ago, the American economist John H. Williams put it in a nutshell, and I quote, "The natural rate is an abstraction like faith. It's seen only by its works, and one can only say that if the bank policy succeeds in stabilizing prices, the bank rate must have been brought in line with the natural rate, but if it does not, it must not have been." So what is more, ultra-expansionary monetary policy compressed long-term interest rates for a prolonged period of time, which may feed also into estimates of the natural rate. In addition, many methods of estimation fail to take into account of the risk dimension that prevails in the real economy. They often use as a starting point yields on government bonds, which are regularly deemed riskless, and that's a separate discussion we can have the next time. But the concept of the natural rate refers to characteristics of the real economy, so it would be appropriate to apply a risk-bearing return on capital. And taking this observation on board and analyzing returns on equity or total capital, say, we see a different picture. There is no sign of any long-term downward trend. So all in all, a study carried out by the Bundesbank comes to the following conclusion. A robust monetary policy strategy should not lean too heavily on the concept of the natural interest rate, but it should regard it instead as one of many indicators for evaluating the monetary policy stance whilst remaining aware of its limitations. And that's a good stance to take for another reason too. The use of the natural interest rate as a policy benchmark is based on the assumption that the natural rate is independent of the policy itself. And this proposition has recently again been challenged or called into question. Economists at the Bank for International Settlements point out that economic developments are determined not just by business cycles, but also by financial cycles, amongst other things. In particular, a financial crisis can dampen the output path of an economy persistently. And consequently, the BIS economists write, to the extent that monetary policy can influence the financial cycle, it too may have a persistent impact on the economic long-run path and hence also on real interest rates. The impact of this finding extends far beyond the use of the natural interest rate as a benchmark for monetary policy. It also raises the issue of whether monetary policymakers should focus more of their attention on the financial cycle. As we have witnessed, financial crises have a considerable effect on macroeconomic outcomes and ultimately on central banks' ability to guarantee price stability. Since the financial cycle is longer than the business cycle, this comes down to extending the policy horizon of monetary policy. Jacques-Yves Cousteau, the pioneer of modern underwater diving, was well aware that it is often a good idea to take the longer-term perspective too. Speaking in 1992, he said, "We are living in an interminable succession of absurdities imposed by the myopic logic of short-term thinking." Taking a longer-term perspective on inflation, central banks might be compelled to act on the build-up of financial imbalances, even if they pursue only the single objective of price stability. And this would also help to reduce asymmetric responses by monetary policy. I'm convinced that monetary policy should have a symmetrical effect over the entire economic cycle. In a downturn, policymakers must respond vigorously, but in an upswing, when risks in the financial sector are building up, they must also be able to tighten the reins again as needed. Ladies and gentlemen, a golden rule for divers is don't exceed the maximum time. I'd say that that's good advice for speakers too. So I will now, although the consequences are a bit less severe, so I will now bring my speech to a close. As you could have guessed, our financial system is much more stable today than it was 10 years ago. A large number of weaknesses have been addressed and reforms initiated. Now our task is to make sure that the rules that we have created are applied consistently. The former chairman of the Fed, Paul Volcker, recently cautioned that financiers, and that's a quote from him, are slipping back into bad habits, chasing chicanery and lobbying to loosen regulation. We should take his remarks seriously, although I wouldn't subscribe to them literally. There is a danger, though, that the lessons learned from the crisis could be thrown to the winds as the memory from the crisis fades. There's no denying that the financial crisis and its repercussions were bad, but it would be even worse if we learned nothing from it. So thank you very much for your attention, and I wish you, a short rest of the conference. It's only 15 minutes to the end, so thanks for listening to me.